Many investors and their advisors were blindsided by 50% market declines in 2000 and 2008. While you'd like to think that was a wake-up call, many remain asleep at the wheel. This is because few understand what drives the financial markets. Now, it's important for investors to understand there are two primary factors that dictate which investments work and which do not: inflation and economic growth. Since inflation and growth can either move in the same or opposite directions, this means investors face four possible market scenarios. So in highly simplified terms, this can be viewed as four different boxes. So to give you some historical examples, in the 1970s, we had an environment of rising inflation and low growth. In that case, stocks and bonds didn't perform very well, but gold did. In the 1930s, during the Great Depression, we had a period of both falling growth and inflation. In that case, long-term government bonds did well, but stocks did not. The period of 1982 until recently was really a dream scenario for stocks and bonds. Inflation was falling while growth was rising, leading to a multi-decade bull market for both. Now, changes from one box to another don't happen very often, but when they do, their effects can last for decades. And this is why investors are often caught off guard when major changes occur. They're prepared for a past that is familiar rather than a future that is not. Most advisors are still living in the lower left box. They believe their clients are adequately diversified, but many are not. They're diversified within a box, but not between the boxes. And this is why their portfolios often blow up when market turbulence occurs. Now, unfortunately, many investors have been trained to think of portfolio success in terms of a market benchmark. For example, did you beat the S&P 500? Well, this information is interesting. It is meaningless to most individuals. Their true benchmark is not whether they beat the market, but whether they can achieve their lifetime dreams that require money. Does anyone get to the end of their life and say, well, I had to work till 80 instead of 60, but who cares because I beat the S&P 500? Of course they don't. Yet that is the strategy many have adopted. It's a strategy of hope. Hope that they can remain in the lower left box forever. But the good news for investors is they don't need to rely on hope to succeed. They have the option to prepare their portfolios for any outcome, not just the good ones. Now, if given the choice, would you prefer to A, increase your chances of success under any outcome, or B, bet on a single outcome in hopes for the highest possible return? Well, the answer is different for every investor. I can tell you from experience that most would pick choice A, yet their portfolios are positioned for choice B, and they're taking unnecessary risk as a result. So carefully consider the correct answer for your situation. Whatever choice you make, be sure it is an informed one. Don't let your financial dreams become a fantasy because you didn't understand your strategy. And if you're working with an advisor, be sure to have this conversation. You might be surprised to find that your advisor has not thought about this question on your behalf, nor taken the time to understand your personal benchmark. Don't find out the hard way that your advisor has failed to properly diversify your portfolio in a meaningful way. Insignificant tweaks to your allocation are not going to do the trick. Now, if you're interested in learning more about the financial markets, I would encourage you to sign up for our free educational monthly newsletter at GodsellReport.com. Godsell & Hughes is a fee-only investment advisor that aims to provide thoughtful portfolio solutions at a better price. Investors have been paying too much for thoughtless advice for far too long. It's about time someone provides a better option.